Look back over the last 18 months, which has been defined, of course, by the pandemic, the popular view is that there's been huge change and a shift to a new norm. The reality in the banking sector, in particular for the traditional banks, is that the pandemic has not fundamentally changed things. Instead, what it's done is it's validated and accelerated plans and actions that were already in place. Yes, it's true that social distancing has impacted face-to-face contact with customers and colleagues. But it's also true that the shift from physical to digital was already well underway. The main question actually has been whether the banks could maintain operational continuity during this social distancing and lockdown. And in general, they managed to do it pretty well, with the odd hiccup. And this has been helped by the fact that actually they reached a level of digital mass at the time of the outbreak. Had the crisis happened 10 or even 5 years ago, however, I think we'd have seen a different outcome. During the last 18 months, banks have continued to focus on the same things that have always mattered to them: cost and efficiency, revenue protection and enhancement, regulatory compliance, and on maintaining their already strong capital positions. But the pandemic has also forced the banking sector to focus on other imperatives. And it's interesting that from being seen as one of the villains in the financial crisis over a decade ago, perceptions have shifted this time around as banks have taken on a broader social and economic responsibility. They've been supporting people and businesses and facilitating stimulus and relief programs with things such as payment and interest holidays and bounce back loans. They've provided business and operational continuity, keeping contact centres and branches open and maintaining essential services, while also shifting to a predominantly virtual operating model. And they've also had to absorb the inevitable results hit, mainly through the huge provisions that they've had to make. In terms of what happens in the industry in the next 18 to 24 months, I think that we'll see an increase in the level of distressed assets on the bank's books as the aftershock of the pandemic hits the global economy. I think we'll also see continued relentless focus on reducing costs and on shifting the cost-income ratio in the right direction. On the income side, as competition increases and margins remain tight, the banks will be looking for new growth models. We also see renewed efforts to innovate and differentiate around customer service, data analytics, and personalization. There'll also be a further emphasis on sustainability and rethinking the sector's broader purpose and role in society. To prepare for the future, bank operating models have been evolving in several ways by constantly re-evaluating the future role of physical in banking, such as the role of the branch network, and differentiating between simple customer needs and complex interactions and how those are met. By considering the workforce of the future, its needs and new work patterns, such as work from anywhere, and the challenges that this will bring, such as how the bank will monitor staff well-being and maintain cultural cohesion and workforce productivity. By exploring how customers and the bank can benefit through broadening of ecosystems, collaborating and partnering across their operating models through open banking. If we look at the role of technology in the development of the banking sector, it's always struck me as somewhat of a paradox that the same technology that was front and center to enabling that development is the same technology that has subsequently hamstrung the traditional players with inflexible and costly legacy environments. That all said, progress is being made by the major banks, albeit still relatively slowly. As the pandemic has shown, digitization has been and continues to expand at pace, and new technologies are enabling the transformation of legacy environments. Looking forward over the next 5 years, 3 technologies will have the greatest impact on driving change in the sector. The first is cloud adoption. Financial services has been a slow adopter of cloud, experimenting at the periphery with non-critical workloads and cautiously assessing security and data residency concerns. This is changing, and cloud is a major lever available to banks to break their legacy lock-in. The second is what I call data fabric technologies. That is the stack of solutions and technologies to store, extract, validate, consolidate, synchronize, analyze, and decision internal and external and structured and unstructured data to release real value. The third are automation technologies, robotics and other process and workflow automation tools, conversational AI, no-code capability, blockchain, etc. Automation that can release manual workloads so that bank colleagues can focus on value-add activity. When I talk to banks, the same themes emerge time and again as their greatest challenges. How to transform at pace while containing costs and investment. Being able to properly exploit the value of data at scale as a business and customer experience differentiator. Avoiding data and regulatory compliance breaches from anti-money laundering failures and cybercrime, yet at the same time reducing the cost of compliance, which has spiraled over the last decade, as the banks have thrown people and piecemeal solutions at fixing compliance issues. Aside from the fintechs and non-bank entrants, which are changing the dynamics of the sector, we've seen some great success stories in the traditional banking sector. One major bank, for example, has moved to the next level with data and analytics, successfully combining AI-led historical data with behavioral economic patterns to hyper-personalize products and services, with the result of a 9 times increase in digital sales and with a snowball effect of a 42 times increase over 4 years. In terms of how financial institutions go forward with exploiting the value of data, I'd make 2 points. Firstly, for the traditional banks, the short to mid-term is all about execution. At present, some banks are managing to deliver, at least in part, while others are struggling. The focus should be on rebuilding the foundations, data gateways or data engines, elevating data closer to the business. The future is to industrialize and democratize data management at scale. Secondly, for the whole industry, the future will be about new and differentiating data use cases, both those adjacent to banking, such as housing, retail, and trade, and more adventurous, non-adjacent data use cases as new business models emerge. For example, the tracking of a customer's cognitive well-being alongside the health of their finances.